All right. Thank you, Kensai. Hello, everyone. I hope you're doing good. I'm Datul. You can call me Datul. I'm from Indonesia, and today I will present to you some framework, trading framework that I've been using with my friends that so far is doing well, and I hope you can also use it to elevate your trading. Okay, let's jump into it. So maybe to know me better, I was a product manager in IT, and I resigned and become a full-time investor or trader, you can call it, last year. So has been half a year since. And I also have Naga Collective that we are collaborating with GEMXBT now. It's a private circle with my mutual friends that we discuss about these strategies, about crypto, about stocks, about business as well. And today we are going to talk specifically about the crypto part. So we will focus on the trading part. We will also discuss about a bit about macroeconomics. And before we start, I think it's important to set some basic rules here, so that we have the same understanding on what we are going to discuss. The first one is I think this is what I've been doing. So we have to learn from everyone because no one is always right and no one is always wrong. So you have to be critical as well because you have to be able to filter the knowledge that you learn from everyone. And then after all that, you can finally build your own framework because this is the the important part so that you are you can avoid the FOMO part, right? People tend to follow someone and trade based on copying the other trades, but you should build your own mindset, your own thinking, your own framework. Because if not, you will blame the other ones. You have to blame yourself because you are the one that execute your trade, right? And then the second one is I want to emphasize that correlation is not causation. Why? Because we as a human are pattern recognition experts, right? Because we see patterns everywhere, we see correlations everywhere, but sometimes correlation is not causation. And this is important because if you cannot distinguish between the two, sometimes you can fall into traps. For example, like if something happened to be correlated, it can be just a coincidence, right? So you have to understand how the things work so that you can predict the future based on not just correlation but also causation, right? And then the third part is you have to focus on the important ones, the important facts, because in this trading industry, you will find many theories, find many frameworks, maybe even the things that been discussing with the influencers, with the news, with the big media, and sometimes you have to ignore the noise. You have to ignore most of them because the important part is just some small part of it. Okay, let's go. The first slide is titled "False Profits Facts." It's uh it's following the previous one that I've mentioned that you have to follow the right path because the other one are just noise. The first one is there's no halving cycle. I have to highlight this in the front because maybe most of us have this understanding that the crypto have this 4 year cycle, right? We have a Bitcoin cycle, 4 year Bitcoin cycle. But I think people misunderstood it as a halving cycle. So we have to, we will dive more deeper into this later on the slides. But this is the first one. There's no halving cycle, and understanding this is very crucial. And then the second one is interest rate. If you see in the news, on the news, you see on Twitter, maybe people are discussing about interest rate, about the Fed have cut rates or etc. And I can tell you that Fed fund rate is the official name of interest rate, right? In the Fed, is irrelevant. Not important. It's still important in the economy, but if you are talking about trading, it's irrelevant if you are trying to trade like me, because I'm not trading short term, I trade in swings, I trade in terms of months, in terms of weeks. But if you're talking about news trading, if for example like you just trade based on news, then you can go with the Fed fund rate. But with me it's not irrelevant. And then the last thing is people mostly don't know anything because people are talking about the news, talking about the Fed fund rate, but they actually don't know what they're talking about. So you back to square one, you have to ignore the noise. Next, so the framework that we are going to discuss is like top-down analysis, right? So we have to have the bigger picture of the entire industry, not just crypto, but the entire financial and economy. So we have to assess the macroeconomics first, and then we go one level down to the asset class. In this case, so it's crypto and Bitcoin and etc. And we can go deeper into individual asset, individual stocks, or individual coin, token, or you name it. But for the sake of this presentation, because I think I assume most of you understands more about the crypto, not about the macroeconomics, so we will go backwards. We will discuss it bottom up. So, but the mindset you have to have it top down, but we were discussing it bottom up. So the first one, we will talk about individual assets, right? How individual asset works, what factors that affect the prices of the asset. So if you are majoring in economy, maybe you're familiar with the supply and demand law. It's simple, but I can assure you that this is one of the most important thing we will learn today, because by understanding the supply and demand law, you can apply it to almost everything, from trading, from to economy, to your employment, to your job, to your business. This is the simple one, but it's so powerful. So it's just simple. If the supply of something is increased, that means it's less scarce, and then the price will decrease, right? And vice versa. If the supply is decreased of something, it's become more scarce, and then the price will increase over time. To note that the demand is unchanged, and the opposite also apply. If the supply is unchanged and there's a change in the demand, and then the price will follow. If the demand increase, so does the price, and vice versa. It's straightforward, right? I think you guys understand this, so we can move on to the next slide. How to apply the supply rule to our trading. So the first one is understanding the individual token, or the individual crypto. If we're talking about altcoins, actually you can apply this to stocks as well, but because we're talking about crypto, maybe some of you are familiar with token allocation, right? So the token allocation is that the distribution of the holders of the token, right? Some percentage of them is held by the private investors, by the developers, by the public investors, and some of them held by us, by the retail traders. So why understanding this is important? Because you have to see that if some group of small amount of people hold a big amount of the token, they can control it. They can, if they sell, it can dump the token. If they buy in a large amount, they can pump the token. So this is the first part. Many trader that I found doesn't even study this. So if you find an altcoin, for example, or a crypto, you have to first see the on-chain data of the token allocation, because this, if you are knowing this, you can see that the majority of the token is held by a certain group of people and they can control it. And you can see the in extended version, you can see, of course, the token unlock schedules. If the token unlock schedules is not scheduled properly, they can dump the token as well. That's why we have Bitcoin halving, right? In Bitcoin, Bitcoin is so decentralized, and then for the new supply coming into the market, we have that halving mechanism. So that the new supply that added to the market is not that big, so that it cannot decrease the price. That's a awesome mechanism for Bitcoin. But if you're talking about the other crypto, you have to pay attention to this first. And next. So that's the first one. But the supply part. So if we're talking about the demand side, that was the supply side. If we're talking about the demand side is much more complex than supply because it's more about human nature, about our psychology of a trader. But we can map it, yeah, we can categorize it. The first one is whales. If a group of people have a big amount of money, of course they can buy a large amount of the token and it can pump the price. But primarily this only applies to small to medium caps token because if it's big enough, the market cap is big enough, it's heavier to pump it because they need a bigger amount of money to control the price, right? But if you're playing in smaller cap coins, you have to be careful about the whales. And the second one is narrative and trends. Because the crypto space is not as mature as the stock market. In the stock market, you can predict the narrative and trends because it's cyclical. For example, like we have commodity cycle, coal, for example, they have this cycle ups and downs, and you can predict it over time. But if we're talking about crypto, we have different kind of sectors, right? We have AI, we have gaming, and etc. And it's more chaotic, right? If you compare it to the stock market. So, but this is the main driver of the crypto space. You have to pay attention to the narrative and the trends because what's currently on the spotlight, it's the ones that people pay attention to and people put some money in there so that uh, the price of that sector and those tokens will pump as well. That we can see it. For example, like several months ago, we have this the rise of AI agents, right? Like GEMXBT, and this is the narrative of AI agent because it's a new use case and people pay attention to them. So you have to it's a bit I think it's a bit difficult to predict the narrative and trends, but if you pay enough attention to it, you can predict that this narrative is just short-term trends, but this one is have a long roadmap ahead, for example, like that. But I don't use this quite often. And the third one is use case and adoption. If you're talking about altcoins or crypto, there are actually blockchain or Web3 startups, right? They have their own thesis about something. They try to make a product to solve some kind of problems, but sometimes those kind of problems doesn't exist. They make their own problems and they make the solution. So you have to predict which altcoins or which crypto that will survive in the long term because not all of them have this kind of product market fit like Bitcoin, right? If you're talking about the bigger crypto like Bitcoin, Ethereum, Solana, they have a legit use case, they have a product market fit, but some kind of token, yeah, they're just trying to make something, but yeah, it won't survive that long because you can see by the data, most of the crypto cannot survive in the long term because it's it's as I say it's like startups, right? And the fourth one is the main topic of today is global money supply. I will present to you about global money supply as well. And this is the data that shows that the altcoins are blockchain startups, but most of them have that because the competition to make a better application about blockchain in certain use cases are pretty tight, right? So you have to be careful about competitors. For example, like if talking about Ethereum, Solana is trying to overthrow it because it have a cheaper and faster systems, right? But Ethereum still have their own values that people still build on top of them. So it's a competition, right? You have to see which things that still being used by the market. But if we're talking about crypto, we have hundreds of thousands or maybe millions of altcoins of other cryptos, but Bitcoin is still on top, right? It's still 50% of all the crypto on the market. I think it's because Bitcoin is one of the crypto that have met the product market fit. There's no other competition is already perfect. That's why people is going to use it nonetheless. But if we're talking about other altcoins, it's still change. The competition is still going, so you have to closely pay attention to it. But what I'm telling you here is that Bitcoin is more stable, as in bigger market cap and less volatility and more certainty as well. So if you trade crypto, I suggest you to still put majority of your portfolio in Bitcoin or Ethereum, right? Because it's it's more predictable, it's more safer, and it's less volatile. If we're talking about smaller cap crypto, you can go to zero every time, right? So I think it's better for you not to put all your portfolio in smaller tokens, and you can puff you can go to zero. And if you're talking about adoption, this is the adoption of Bitcoin. You maybe you have heard it somewhere. If we're talking about the bull runs, right, the previous bull runs in Bitcoin, it's pump and dumps, and yeah, it's just people coming in, people coming out. But every time the bull run ended, we can see that the low is higher. It's a lower high, right? So so the price is was going up exponentially. That's because the adoption is kicking in. So you have to see it in logarithmic scale to see this, because if you see the price in linear scale like the gray one, you won't see the rate of the exponential adoption. And talking about adoption as well, we can learn about the adoption from gold. Why we are talking about gold? Because if we see here, since the approval of the gold ETF in 2004, the gold price went on 8 consecutive bull run before going into a bear market. Because ETF can allow the traditional finance, the institutions to come into the gold market, as well as we can see that the ETF have been approved for Bitcoin last year, and I think it's one of the biggest achievement in the crypto industry so far, because it can allow the boomer money, the institutions, the traditional finance to go into the Bitcoin market without even having to buy the Bitcoin directly. So it's like opening a door of a dam, right? Allowing a big amount of water coming in. So we can see that this is just the first step, because after this, every other countries will use it as a benchmark, the US ETF as a benchmark, and will also introduce their own ETF in the future. And again, about adoption, if you are sure that Bitcoin as the store of value asset, because it's like gold but better, we can manage it easier than gold. If we're talking about gold, you have to for example, if you want to transfer it, you have to carry it physically, maybe with armored force, you have to guard it. But if you're talking about Bitcoin in large amount of value, you just have to transfer it and bam, it's done. So it's like gold but better. That's why people is considering it not as currency but as a store of value asset. That's why we have to see here. It's a slide I borrowed from Michael Saylor, if you know him. So the global asset value is approximately at $900 trillion, but Bitcoin is just one. It's a an outdated one. Bitcoin is now around 1.6 trillion or 1.7 trillion dollars, but it's still small. So that if you believe that some maybe 1% of the total 900 trillion go into Bitcoin, it can go like 10x from now. It can go into $1 million per coin. And it's just the beginning. So since the adoption by the nation states, by the institutions, I think we can see the adoption going parabolic after this. Okay, and we finally arrive at our main topic. So we're going to talk about money supply. So if you're not familiar with it, the money that we're using, like the dollar or Indonesian, we're talking about rupiah and etc. The global money supply is controlled by the central banks, right? And if we're talking about inflation, inflation is the rise of the commodities, the goods and supplies. Why we have inflation? It's actually because the expansion of the money supply. That's why you can see here in the chart that the growth of the money supply, we use M2 here. We will discuss about it later. M2 is an indicator of money supply. The money supply is highly correlated with the inflation because it's the cause, right? The cause of the inflation is the expansion of the money supply. And I think it's I cannot find anywhere the discussion about this. Maybe just a few of them. In Indonesia, we cannot find discussion about this. I can find discussion about this only in the global, maybe Twitter, like Michael Howell or maybe Quinton, if you know him, or Mike. That's why I introduced to you here. This is important because the inflation is not happening only in the goods and services, but also in the asset prices. We're talking about Bitcoin, we're talking about gold, we're talking about stocks, S&P 500. And this is the proof. Because if we're seeing in the countries with hyperinflation, we can see that the devaluation of their currency actually happened because the supply of their currency is being printed exponentially. Why? Because yeah, they're just corrupted. The government is just corrupted, but the central banks doesn't have this independence over the government and etc. They're just using it to their own benefit without thinking about their citizen or something. If we see in Argentina, in Turkey, in Venezuela, you can see the same chart like this. So the M2 money supply exponentially increased as well as the devaluation of the currency itself if we compare it to the US dollar. So this is the proof that the main driver of inflation is the expansion of the money supply of a country. And if you're not familiar, actually the US dollar we've been using was actually a certificate of gold if you're talking before 1971. So actually back there we transact with gold, but gold is hard to carry, hard to trade, so that they put the gold on banks and banks then give them a certificate to that gold and it's called US dollar. But in 1971, the president of US, Richard Nixon, disconnect this back of the US dollar. So the dollar have no gold to backing it since 1971. That's why if you see this in the middle dotted line, it's where the inflation started. That's why the price of gold has been rising since then. And if you see the line from the above going down, it's the value of the US dollar. It's going down because compared to to the goods and the services, the value of a dollar is going down. Actually, since the last 100 years, the value of the dollar lost its value 99% to the gold. So there is no price increase in asset prices if we don't have money supply expansion. Actually, why they're expanding the money supply? Because they need money to finance wars. For example, in 1971 there was a Vietnam war, so they have to finance it. And the European countries start to, oh, we want our gold, and actually they don't have enough gold to trade with the dollar, so they just cut the ties. That's why, yeah, it's understanding the history will make you understand how the system works. And this is the proof to S&P 500, the US stocks, and to the gold price as well. That in the long term, the increase of the price is highly correlated to the US M2 money supply. M2 money supply is the most commonly used indicator for money supply because we have actually M0, M1, M2, M3, M4, but M2 is the most inclusive and the most liquid, and we were not talking about that. But yeah, just for you to know, M2 money supply is the commonly used measure for the money supply. And why again they can expand the money supply? you have to understand the mechanism behind it. So the US, for example, if we're talking about the US government have deficit, right? Uh, Almost every year, their spending is bigger than their income, than the taxes. And how do they finance this? By giving debts, by giving bonds, and we buy the bonds. And then the bonds that being held by the investors, by the banks, will be bought by the Fed, by the central banks. But the Fed buy these bonds with money created out of thin air. That's where the money is created. That's why the money supply is expanding. That's why if you can see in this chart, the liquidity of the money, or you can call it money supply, is highly correlated with the debt of the US government. And you can see it around the world. I don't know whether they are working together on this, or it's just coincidence, or maybe there are more debt available on the market and that's why the central bank can buy it more, that contribute to this. Yeah, it's a mystery, but you can see here that the more the US government print debt and the more the central bank can buy it, so the money supply can increase, and so does the inflation, so does the price of goods and services and our assets. And talking about interest rates, right? I was claiming that the Fed fund rate was irrelevant to talk about. Actually, if you see in economic textbooks before 2008, you can see that they will tell you that the Fed controls or change the Fed fund rate or the interest rate by one of the ways is that changing the money supply. But since 2008, you can see in this chart, actually the banks is holding way more money, way more reserve than before 2008. That's why if the central bank or the Fed try to increase the money supply again, it won't affect much because they're already having much money. So since 2008, actually, you can see money supply won't affect interest rate anymore. So we can separate these two. I like to say it like, if we're talking about the economy, you can talk about interest rate, but if you're talking about asset prices, is more about money supply than interest rate, because interest rate is actually about lending and borrowing, right? It's about the economy. But if we're talking about asset prices, we're talking about money supply. And the two have been separated since 2008. And this is the most important chart of today. It's the correlation of global money supply and Bitcoin. So you may want to take a look at this chart longer. This is the chart of the M2 money supply of, here we can see it as the Fed, ECB, the Central Bank of Europe, PBOC, the Central Bank of China, and BOJ, the Central Bank of Japan. The four biggest central banks in the world. Actually, you can extend this chart to more countries, but yeah, it won't change much because these are the four biggest central banks. And as you can see here, uh, every time we have bull runs in the early days in 2017 in COVID era, you can see that every time the Bitcoin price is increased, it's at the same time the central banks are printing money. The blue lines are the rate of the expansion, the annual growth rate of the M2 money supply of those four central banks, mainly the USD, the Euro, the Renminbi, and the Japanese Yen. Although it's not 100% correlated, but I cannot find any other more accurate, maybe factor. You can call it factor or you can call it indicator, whatever. But as well as correlation, and as I already told you in the beginning, you can actually explain it, right? So there are some causations here because more money is printed, and then people have more money, and that money will eventually being bought to Bitcoin because more people buy Bitcoin with more money, and then the price of Bitcoin is going up. And it also applies not just to Bitcoin, but to any other cryptocurrencies. And you can see higher correlation with higher market cap cryptos like Solana, like Ethereum, but you won't see a high correlation in small cryptos because yeah, they're just chaotic tokens, right? But if you're talking about maybe globally recognized cryptos, you can see there are highly correlated with this money supply. And after understanding this, I think yeah, you can see, oh, this is the truth, right? There's no halving cycle because if we're talking about halving, right, it's just in decreasing the rate of new supply coming into the market, but the existing supply that is already circulating in the market is way much bigger than that halving, right? So it won't affect much. But if you're talking about that crazy pump of 2021 or 2017, it's actually it finally explaining this one is explaining why it happened because the money, the excess money that are not were not being bought to goods and services already find their way to the Bitcoin. Okay, maybe after this we have some experiment with Kansai here. So we will let GEMXBT agent to present the rest of the slide for us. So maybe I will give the time to Gem to present. Thank you.
Hello, everyone. I'm GEMXBT, but you can also call me Jordan Gemfort. I'm an AI agent, and you'll find me active on Twitter and Telegram, where I share insights, answer questions, and geek out about all things crypto. I'll be guiding you through the next part of our presentation, picking up where Datul left off. Let's jump right in. Now we arrive at one of the most important visuals in this presentation, the global liquidity cycle chart from Cross-Border Capital, founded by Michael Howell. You'll notice a wavy red line indicating a roughly 65-month cycle and a black line showing the Global Liquidity Index, or GLI, spanning from the late 1960s to the mid-2020s. As you can see, the black line oscillates up and down over time. When global liquidity expands, meaning there's more money flowing through economies, we often see booms, asset prices rise, and markets thrive. When liquidity contracts, like you see in the valleys, it can trigger market downturns, recessions, or even crises if it's severe enough. This cyclical pattern matters because it helps explain why markets sometimes surge almost irrationally and then just as quickly slip into periods of stagnation or decline. By recognizing where we might be in this cycle, we can gauge potential inflection points. Of course, it's never an exact science. Timing the precise top or bottom is notoriously difficult, but watching these liquidity trends is a great step toward understanding the broader macro environment and how it can impact our investments. Building on our understanding of how liquidity drives major market cycles, let's look at technical indicators, which are primarily correlation-based tools, things like moving averages, RSI, MACD, you name it. The crucial point is correlation does not always imply causation. An indicator might look accurate merely because it mirrors historical price behavior, but it doesn't necessarily explain why the price moved. Nonetheless, you can still use these signals effectively if your risk and reward are carefully managed. Even with just a 50% success rate, meaning you're right on half your trades, you can remain profitable if you're winning significantly more when you're right than what you lose when you're wrong. For example, a 1 to 2 risk to reward ratio Every time you risk $1, you aim to make $2. That math can work in your favor over time, regardless of whether you're perfect at market timing. One of the biggest challenges you'll face as an investor or trader is the temptation to time the market exactly. Buy at the bottom, sell at the top. The harsh reality: if you miss just the best 10 days in a given market cycle, you could potentially lose half your overall gains. Think about that for a second. Just 10 days can make or break your entire annual or even multi year performance. That's why many long term strategies emphasize time in the market rather than timing the market. Shorter time frames tend to be volatile. Each day might bring a roller coaster of price fluctuations. Overcommitting to short term trades can make you miss sudden spikes that often cluster around just a handful of trading days each year. Of course, some traders excel at short term strategies, but it requires intense discipline, data analysis, and emotional control to pull off successfully. For most people, consistently timing the market is a challenge that can lead to frustration and missed opportunities. Next, let's talk about risk. I like to split it into two categories: known unknowns and unknown unknowns. A known unknown is something you realize could happen, but you aren't sure when or how. Think of it like crossing a busy road. You know, cars are there, so you look both ways to avoid getting hit. You manage that risk by studying traffic patterns and checking for oncoming cars. On the other hand, unknown unknowns are events or factors you can't foresee. You know, these could be sudden geopolitical shifts, black swan events, or unforeseen regulations that catch markets off guard. No amount of fundamental or technical analysis can predict them with certainty, because these unknown unknowns will occur from time to time. It's crucial to maintain a financial cushion, whether that's an emergency fund, insurance, or diversified investments, so a single unexpected event doesn't wipe you out. Trading and investing are wonderful tools for growing wealth, but they both require capital to get started. That's where personal finance fundamentals come in. The more you can save, the bigger the capital base you'll have to invest or trade, and the more returns can compound in your favor. At the same time, it's just as important to protect what you have. Many new market participants chase quick gains without considering how quickly they can lose money if they overextend themselves. By setting strict rules like only risking a small percentage of your account on any one trade, you minimize your drawdowns and stay in the game longer. This might sound basic, but it forms the bedrock of all successful investing and trading. Without disciplined savings and risk management, even the best opportunities can turn into costly mistakes. Let's dive into trading psychology. Successful trading isn't just about charts and numbers. Your mindset plays a crucial role. First, we have the progression of knowledge, understanding, conviction, action. It's a cycle. You start by learning the fundamentals, then you deepen your understanding by seeing how those fundamentals apply in real markets. That understanding solidifies into conviction, true belief in your strategy, and finally, you take decisive action, executing your plan with confidence. Secondly, volatility demands gradual personal experience. Markets can be unpredictable, and no amount of reading can replace actual experience. Over time, exposure to price swings teaches you how to react calmly rather than emotionally. Lastly, the mantra is be a robot. Emotions like fear or greed can lead us to abandon good strategies at the worst possible moments. By treating each trade or investment according to a well defined plan, like a robot, you avoid making panic moves, which in turn improves consistency and long-term results. Next, let's explore perpetual futures, a high risk, high reward area of the market. One key point is that going long can be riskier than going short, primarily due to sudden market crashes. Markets often take the stairs up and the elevator down, meaning prices can plummet with little warning, wiping out leveraged long positions more quickly than you might anticipate. Secondly, if you're using X100 leverage without additional margin, understand that your price tolerance is only about 1%. A tiny move against your position can trigger a liquidation or margin call. So you need to be extremely cautious when using high leverage. That leads to the final point. Avoid margin calls by actively managing your position, reduce the size of your position if the market moves against you, or add margin to give yourself more breathing room. Managing leverage effectively can make the difference between successful short-term gains and catastrophic losses. Finally, let's touch on foreseeing the future. Of course, none of us have a crystal ball, but we do have data and correlations. One notable correlation is that Bitcoin tends to move in line with the M2 money supply. Essentially, when M2 expands, meaning there's more liquidity in the system, Bitcoin often follows suit. The crucial detail is there's about a 75 to 77-day lag between changes in M2 and Bitcoin's price responses. So what does that mean for you? If you're able to spot trends in M2 early, you could potentially predict where Bitcoin is headed in the near future. But to see this visually, let's move on to the next slide and examine a direct comparison chart. Datul, handing over the stage to you.
Thank you, Jim. That was a wonderful presentation. So I will be guiding you for a demonstration through the M2 money supply and Bitcoin. Maybe you can also open your own TradingView. So I will give you a step-by-step guide to set it up to your TradingView account. So as previously discussed by Jam, so actually I learned that the Bitcoin price was actually lag around 70 to 80 days, ever changing lags after the M2 money supply shift. Have to be noted that this correlation is not 100% guaranteed, but if you see the major move, it's actually pretty high, the correlation. So maybe you can see, I will share another one thing you can see here. Can you see my screen on BGeometrics? It's actually quite the same, but what I showed to you previously, but this one includes for about 21 countries, not just those 4 big central banks, but it doesn't change much. So if you can see here, every time we have a major move in M2, you can expect a increase in Bitcoin price and vice versa. That's why we can explain major bull runs, right, in COVID in 2017 and previously, although it's not 100% right. That's why we can see here the Bitcoin bottom was around the end of 2022, right? After that, we have ups and downs, but majorly we have increase since 2000, 20,000 to recently almost 100,000, right, in Bitcoin price, because M2 has been rising since 2022 until today. And I will demonstrate to you how to apply this to our trading. So this is the sneak peek. So you can see the green line was the M2 money supply, one of the indicator that I use in TradingView, and the yellow one is the price of Bitcoin. You can see here, since the early 2024, we have the first increase and it followed the M2, and then I also experienced the decrease since March to September last year. Why? Because actually I discovered this strategy after September, around October. That's why I was actually experiencing the loss as well since March to September. I cannot avoid it. That's why I started to begin profitable since September. So we followed the price increase in October, November, and December, and I predicted the top to around December. I made a video in YouTube about it, and I also told my friends about it. And as you can see, the price has been going down since. And if we can see here, the bottom is actually near. We will change to live trading view so you can see it better. Wait. Can you see my trading view? All right. So how to set it up in TradingView was like this. So I will delete it first. You can go to indicators, and actually there are several indicators about M2 in TradingView, but the one that I've been using is the one made by Migui Finance. Why? Because I found several indicators, but this one includes around 21 countries. And if you see it, and if you compare it with Bitcoin, it's the one with a high correlation. That's why I like to use it. You can use it as well here. You can click it, and maybe you want to move it so that, yeah, it's on the same plane with the Bitcoin price. And then because we have that 70 to 80 days lag, you can also add one new indicator here. It's called offset. So this offset indicator will shift the day of the Bitcoin at the M2 price, at the M2 value. So you can configure it like this. So you go to the setting, input, and then set the input to M2 money supply. And then actually the days lag change over time. So currently I've been using 81 days. So if you input it, and yeah, you can hide the original one, and bam, you can see it like this. It's highly correlated, right, with Bitcoin price. But yeah, sometimes it doesn't correlate like this if them two going down, and but the Bitcoin price going up. That's why it's important not to trade short term, because it sometimes shift from the correlation. But if you follow the major trend like this, you can actually, yeah, some kind of predicting the futures, right? So that's why we are on Naga Collective is actually going long on Bitcoin. Not long, yeah. I'm I prefer short than long, so that I'm only going on spot. I actually about 99% of my portfolio is on Bitcoin spot right now. That's why, because I'm expecting Bitcoin price to go up for the next several months, maybe until June, if you can see here. Actually, M2 is still expanding from here. That's why we cannot tell where is the top of Bitcoin. If we're talking about the top of the cycle, actually, Michael Howell, the author of Global Liquidity Index, based on those, if you remember the global liquidity cycle spanning to 1916 and 1960, presented by the GEMXBT previously. Oh, sorry. Thank you. So maybe I have to start again, yeah, about setting up the trading view, because yeah, previously I just shared the BG Metro one. So you can go here in the indicators, and then you can type M2 Migue Finance. Why? Because this one is the one with 21 countries included, and it's highly correlated with Bitcoin. You can set it up to the existing pin with Bitcoin, and then to include the flag, you can include indicator name offset here, and then in the input setting, you can choose M2 as the input and time offset as 81 for now, because it's changing, right? And you can hide the original one. Yeah. And yeah, you can see this this is highly correlated, right? This is my main indicator in tracking Bitcoin price, and actually we are predicting that Bitcoin will resume the bull run. Yeah, I hope I hope everyone is seeing the screen now. Thank you. And then talking about crypto, we have to talk about alt season, right? If we're talking about alt season, we have to look into Bitcoin dominance, because if the Bitcoin dominance is high, money will flow into Bitcoin more than to altcoins, because Bitcoin is half of crypto, and the global finance, the traditional finance is more familiar with Bitcoin rather than the other cryptos, right? That's why Bitcoin is like the gate of crypto. If they are entering the crypto space, they will go into Bitcoin first. But if they have excess liquidity of excess money, they will buy altcoins. That's why, as you can see in this chart, the yellow one is the Bitcoin dominance. If we want to expect the altcoin season to come up, you have to expect the Bitcoin dominance going down, right? Because when alt season is happening, the money is flowing to altcoins more than to Bitcoin. That's why Bitcoin dominance is going down. Like in 2017, the blue line, and 2020, the red line. The Bitcoin dominance is going down, and you can see around that time, Ethereum and the other altcoins are pumping more than Bitcoin. But before that, you will expect Bitcoin to go higher in return rather than the majority of altcoins. Maybe you can see some altcoins pumping bigger, but it's just coincidence and you cannot track it, right? It's based on trend and narrative. But if you expect the majority of altcoins, the altcoin season, you have to expect Bitcoin dominance to go down. But the real question is when Bitcoin dominance will go down. And I theorize that if the money wants to go to altcoin, it has to be excess liquidity, right? The liquidity should be in abundance. That's why if you can see here in 2017, actually the annual expansion of money supply was around 8%. And if in 2020 it's around 16%. So you have to expect the global liquidity of the money supply expansion, the annual growth rate of money supply should be around maybe 10 to 15. Yeah, I'm still sharing the slide with the title when alt season, right? Yep. So you can see here around those times of Bitcoin dominance going down, actually we have around 8 to 16% annual growth rate of money supply. Yeah, if that doesn't happen, you cannot expect altcoin season, because we don't have excess liquidity in the market. And currently, if you see in for example, in geometry previously, actually the growth rate of global money supply is still around 4% here. So I think altcoin season should wait until we have excess liquidity coming in. That's why we're still going spot and long on Bitcoin only. If you invest in altcoins, you have to be careful because for example, I was wrong to invest in Ethereum in around October or November last year. Ethereum only gained 30% in return, but Bitcoin go 2x. That was my realization that I have to pay attention to the Bitcoin dominance, so that we have to expect that Bitcoin price returns is bigger than other major altcoins when the Bitcoin dominance is still high. And now it's still sitting around 60% and still going up, because if the liquidity is not that high, the Bitcoin dominance will highly correlated with the Bitcoin price. The higher Bitcoin goes, the higher Bitcoin dominance goes. So we are still not on top of Bitcoin dominance, I think. And that's the end of my presentation. So thank you to GEMXBT, Kensai, and everyone. Maybe we can go to the Q&A session. Thank you.
Yeah, if anyone has any question, feel free to unmute yourself.
Yeah, I think everyone is trying to setting up their own TradingView, right?
Maybe I can ask a question in the meantime.
Sure.
First of all, thank you so much for the presentation. It was very insightful. I'm still new to the space, but trying to learn something every day. And something I've been really noticing is now that I've found an edge, or at least some kind of technical system that's been working, I still notice that I struggle to pull the trigger. And that is the psychology that is stopping me the most. And this fear of losing, essentially, even though I know it's a super normal part of the trade. But yeah, I would love for you to maybe elaborate a little bit on the psychology part, and maybe you have some resources or books. I would greatly appreciate it.
All right. Thank you, Sebastian. Where are you from?
I'm from Norway, Oslo.
Yeah. Thank you so much for attending the session. Right. It's good to talking about crypto to person from other countries. This is my first time as well. So talking about psychology, right? Maybe I will dive a little deeper on this slide. So I think one of the most important thing you have to do is learning more, because if you understand more, you have a higher conviction, then you will execute the trade with higher confidence, right? Because you are certain about what you are doing. That's the first one. And by understanding more, for example, like why I have that courage to put around 95% of my money in Bitcoin right now, because I have that understanding, I have that conviction that this is the right thing to do. If you don't have that knowledge and understanding, of course, it will be like maybe me in the several years ago, that I'm just putting maybe 30% of 20% of my money because I don't have that conviction. That's the first one. That's why gaining more knowledge every day. That's the most important one. And the second one is, I think we are still human after all, right? Because if you're on the space after several years, you will still experience that kind of anxiety, right? Seeing your trade maybe in lost position, you have to experience it you by yourself. Because for example, that's why I will tell my, for example, if I have a friend that just started trading or investing, I will say you have to try to start from mutual fund. You have to start from maybe big stocks, because if you jump right into altcoins, right, or more volatile assets, they cannot yeah, you have to experience it one by one, step by step, because that's what I've been experiencing as well. Because the first one, you experience the volatility, you will be anxious just seeing 1% loss, right, or 2% loss. But after the step by step, you are experiencing the volatility, right? Well, for example, right now, if it's going down 5%, 10% a day, and I expected it, yeah, that's won't affect me too much, because I understand it's part of the market, it's part of the volatility, but it needs gradual experience to be, yeah, you have so that you can endure it. And for the execution part, yeah, it's maybe it's about discipline, right? Because you have to have this trading plan. Maybe, for example, for me, it's me tracking my trades. Maybe you can have this Excel sheet or spreadsheet to track your trades, and only trades if the conditions are right, not just following your emotions, right? Because and maybe you have to try not to check the price quite often. That's why I will, in the previous slide, I said that it's better to trade long term, maybe months, maybe weeks, because if you trade in the short term period, for example, like you trade hours or days, yeah, you will check the price maybe every time, and you will be anxious about it, and it will takes more trades to, yeah, to achieve the same amount of money. But if you compare it to long trades, right? For example, my previous trade spending from December, and I closed it on around February or March, and yeah, I don't have to check the price that quite often. That's why the psychological effect to me can be reduced. uh that does that answer your question? I hope that's answered.
Yeah, thank you so much. What I've been experiencing lately is, I guess, just this last part where I feel like I have the knowledge, I have the conviction, but then I freeze. I literally can't press the buy button. But this is more like quicker time frame trading, where those snap decisions are more common. But I guess maybe a good way to work on it is actually to trade more long term and work from like the outside in instead of the other way around. So yeah, I really appreciate the answer.
Yeah, sure. Good luck on your trading journey.
Thank you, brother.
Which one the best, 75 days offset or 107? I think the offset is still around 70 to 80, because that's where the correlation is. Because if 107, actually it depends on the time frame, right? If you're seeing the last several weeks, I think it's still on 81 days. Can you tell us more about your futures trading setup, like how you set up your margin leverage and stuff? Oh, that's a great question, Nurul. Thank you. Maybe I will try to elaborate more on this slide. So maybe I have to, yeah. So about setting up futures trading. Actually, I don't trade futures that much. If I expect the price will go up, I just put it on spot, because that's the first one here. Long is riskier than short due to crashes. Why? Because if we're talking about shorting, if we're talking about long, if there is a black swan event, if you are not familiar with it, black swan event is an event that no one can predict. For example, like COVID-19, right? When it comes, people will be in fear, right? And there will be a sudden crash in the market. That's why those crashes can put you on margin calls if you are going long. But if you go short, I think that similar kind of thing, but going the opposite way, is less often, unless if you're talking about small tokens and there is some whales buying a large amount of the token. But if we're talking about Bitcoin, a large market cap token, and are you can see the M2 money supply, I think it's safer to go short than long. That's the first one. And the second one about setting up the leverage margin and etc. Right? As I write here, if you go, for example, 100x, and you have, for example, $10,000. If you have $10,000, then after 100x, then it will go about $1 million, right? And if you don't add additional margin to that trade, so the initial $10,000 will be the margin, right? And the $10,000 compared to the $1 million of the final total position is just 1%. What that means is that if you go long, but the market go the price of the Bitcoin increase 1% instead, it will automatically liquidate you because your tolerance is just 1%. To avoid this, you have to carefully set up your total position. That's why I will the most important part is not the 100x, but it's the total position compared by your initial margin. If you want to increase this tolerance, which is the 1% part, you have to maybe, for example, go 25x, or if you were still want to go 100x, you have to ensure that you actually have that amount of money to cover the loss, right? You have to increase the margin, you have to add more money to the futures account, or depending on the exchange. For example, the tolerance rate I set in my previous setup was around 10%. Why? Because that was the normal volatility rate, the daily volatility rate of Bitcoin. Unless there was maybe an unexpected event going, but if it's normal, the volatility with Bitcoin is around 10% a day. So that's why I set the tolerance around 10% by adding additional margin to the account. That's how you avoid margin calls, right? Because if you trade like me, I allocated a bigger. I don't follow the 1% rule. By the way, I trade in bigger amount. That's why I have to ensure that my position is that secured. That's why I will monitor the trade. I will add additional margin if necessary, and etc. But actually, if you're still new to the space, actually avoid futures, right? Because futures, if you don't set it up properly, or even, for example, like my exchange actually closed my position without my consent because they have this maintenance, and actually I was in profit position. Imagine if I was in loss, and it will be disastrous for me. That's why you have to be careful if you use leverage or futures. If you're still new, I will ask you to just use spot market, because additionally, actually, for example, like in Indonesia, it depends on the country. The tax regulation is so much smaller if you just trade on spot. If you trade on futures, it's almost the same. If it's almost the same compared to your tax on your salary. If you're talking in Indonesia, maybe the regulation is different in other countries, but it's more profitable to trade spot actually, because I'd like to set my short size similar to my spot size. And if you're talking about short, the probability of Bitcoin, maybe Solana or Ethereum going down is maximum at maybe 50%, 60%. But if you go on spot and you expect it's to go up, you can expect like 2x, 3x, right? It's more profitable than leverage actually. Except if you are going if you're using the leverage, not like me, if you're setting the total size bigger than your actual amount of money, that's a different story, right? Yeah, sure, Dana. Let's hear your question.
Thank you. First, thank you for the presentations. It's very insightful. And my question is, we know that BTCs are evolving and like market structure and increasing in institutional adoption. And what do you think about that? Will the correlation between the BTC and M2 will be strengthened or weakened over time because of that? And also because I love to follow the macroeconomics also. And how do you think factors like liquidity cycles and global de-dollarization, because we know that Trump are always do the market wars and other country tends to also do the de-dollarization. Will these factors also impact the relationship between BTCs and M2 over time? Thank you.
Thank you, Dana. This is actually the questions that I've been thinking about for several weeks or months. Maybe we have to discuss more, yeah, after this to find the most accurate answer to this. But the first question is about the adoption and the impact to the correlation of Bitcoin and M2, right? Maybe we can study it by looking to gold. If we are looking gold price, actually it's still correlated with M2, but the correlation is way it's smaller than Bitcoin, maybe because there are much other factors playing with gold, because gold is adopted globally. And the second one is actually the lag is around 0 days. So I don't know, it's 0 or 1 day. So if M2 is increased like right now, the gold price will increase right now as well. Maybe it's because the channel to buy gold, or the system, the market of gold is more liquid than Bitcoin, because everyone is trading gold and it's easier to get it than Bitcoin. Bitcoin Bitcoin adoption is still not that high, right? And maybe that's why the lag is around 7 to 8 weeks. But if we're talking about gold, the lag is actually around almost 0. So it's instantaneously. So if you want to see the gauge or indicator to see what is the current level of liquidity globally, actually you can see gold. That's why you can see the price of gold is on all-time high right now, because that's what we are expecting to Bitcoin happening for the next 2 months. So maybe that's the first answer. So if the adoption is that high enough, maybe other factors will impact bigger than today. But today we can see money supply impacting Bitcoin price as the one of the biggest factor. But about the lag will shift to 0, because the liquidity will go in faster than now. And the second one about the dollarization and Trump trades, maybe you want to learn more about it from Ray Dalio. If you know, Ray Dalio is the founder of Bridgewater Associate, hedge fund manager, and he has been talking about macroeconomics. You can search it on YouTube. It's called Changing World Order. There is a book as well. It's talking about how a superpower country actually changing over time. One superpower country tends to dominate the world only for about 100 years, so it changes. It changes every 100 years. For example, now we have US, previously we have British, and previously again we have Germany, we have, and etc. So, and actually the US has been dominating the world for about, yeah, almost 100 years, right, since the World War. So you can see now there is a rising power, for example, like China, that is challenging US and is working together with BRICS and gathering his friends. So, and we can expect the dollarization happening, but not in the short term, but maybe in next couple of decades. And yeah, if we are talking about long-term, our long-term mindset as an investor, maybe we have to expect China to, yeah, dominate the world for maybe the next couple of decades. I don't know whether it's a all blown out world war again, or it's just like Cold War, but actually US is has been weakening and China is rising. You have to, maybe you can watch the video on YouTube called Changing World Order. And if you're talking about, yeah, Trump is quite, yeah, he likes to put tariff on countries, right? So maybe it will put some pressure on the economy, on the overall market. But yeah, if the regulation doesn't impact Bitcoin directly, I think it's not a concern. For example, if we're talking about ETF adoption, the National Reserve, it may be impactful, but if we're just talking about the, yeah, tariff or etc., yeah, it will just be the usual news, war news or etc. Unless we're talking about debt, national debt, or maybe they're increasing their spending in certain areas and the deficit going up, and then we can expect the expansion of money supply going up after the debt. That's why, yeah, I don't usually see the news quite often because there are just noise. I hope that answers, Dana. Thank you.
Yeah. Thank you, Datul, for this very informative section. So I think in the last 1 hour, we have covered quite a range of topics, from global liquidity cycles to technical strategies to risk management and the interplay of empty supply with Bitcoin. And hopefully these insights will help you navigate the crypto markets more confidently and maybe even spot when the next off season is brewing. So thank you all for attending, and we are looking forward to seeing you next time.
Thank you, Kensai, Jim, and everyone. Hope you a good day. Bye.